everybody, to episode 69 of Top of Mind with Consilio Wealth. Today is April 8th, 9:56 in the morning. Those of you tuning in on YouTube, green light behind me, markets are up today. This is the first positive day we've seen in a little while. After Liberation Day was announced, which turned two back-to-back very, very red days in U.S. markets. So we wanted to record this, really just giving all of our listeners, including our clients and everybody that tunes into this, our perspective on what in the world's going on in markets right now. What kind of happened and what was discussed on this so-called Liberation Day, and really what do we think is next and kind of coming in the coming days and weeks for markets and policy. So I'm joined as always by Hao. And Hao, how are you?
Good.
Much
better, given some time, right?
Yeah. Let's dive in. So let's just start with where are markets at now? What's going on? What's the state of play right now in markets?
Yeah, the market's in officially bear market territory, which is the technical definition 20% down from its previous high. So the S&P is right there. It's at about 18.5% down. Mm-hmm. And the NASDAQ is officially safely in bear market territory. I don't know why I use the word safely, but it's 21% down. A little bit more juice in that particular index, right? So that's more tech heavy or growth heavy index. And then internationally, we're looking at my international ticker fell off. Give me a sec here. Sorry. International, everything but the U.S., right, is down 14%. So that was a bright spot earlier in the year when the tariffs were first announced. Everyone shuffled money towards international. Again, that's the fallacy of chasing return, right? Because you saw that, hey, international's doing well. They're going to keep doing well. I'm going to sell my U.S. stocks and buy international, only to see it drop off and match what the U.S. and the NASDAQ are doing. So the basically what it tells me is the broad sell-off, or the sell-off broadened to the whole world. We're going to start off as a U.S.-based sell-off from my point of view. And that's because tariffs don't really benefit anyone, to be clear. I think that's probably the clearest stance we're going to take here, is if you're a business that even operates within a domicile, within a domestic country, there's some form or fashion that you're importing something, right, overseas, or worse, you're exporting something out, and you can't really help that, right? We mentioned Ford vehicles. They go over the Canadian border 7 or 8 times before the finished product comes back to the U.S. Or goes to Europe or wherever. That's the same thing with Mexico. And Ford's a pretty locked in U.S. brand, right? You think U.S., you think Ford, you think GM. And even they are not completely isolated in terms of production to the U.S., right? And obviously they sell vehicles across borders too, so they have an interest of keeping supply chains healthy and also keeping sales growth healthy overseas, right? Just trying to break it down to the simplest of terms. Yeah.
Well, I think, let's even pivot and discuss what are they trying to do? Because I think there's been a lot of kind of media and articles that are centered around, the administration's breaking everything and causing a recession. And I despite what side that you might be on, I find it hard to believe that all of these people are sitting around the White House and saying, let's do this to break the economy, right? So that's not what their actual intent is. So let's just discuss for a minute what the
Yeah,
intent is behind these policies.
people like Bill Ackman are putting out that Howard Lutnick, who does own the majority of Cantor Fitzgerald, he says they do have levered treasury holdings, which traditionally Treasury does do really well when there's a recession or a sharp market sell-off like we just had. That's a very cynical point of view. One, I think that would be illegal if you had steered the economy to enrich your own portfolio. But that's the thing, is Howard Lutnick still owns Cantor Fitzgerald. Cantor Fitzgerald does do private real estate deals, and they do have quite a few hedging portfolios that are able to do something like that. I don't know if Bill Ackman has more insight than we do, but that could be a conflict of interest, right? That we should address. Is one of Trump's closest advisors, Howard Lutnick, who is the Commerce Secretary, does have invested interest in certain things doing well when the economy doesn't do so well.
That's interesting. Yeah, so there could be some conflicts. Okay. But coming back a little bit, so I mean, I think what are they trying to do? They're trying to incent companies to come to the U.S. to manufacture their products, whether that means open up a new car manufacturing facility, that sort of thing, right? They're trying to onshore some of the things that have been outsourced for many, many years, and with that, then also bring American companies into a competitive nature once again. And so one example that I would give is like steel, for example. It's hard, I think, for the U.S. to compete with steel coming out of China. It's so much cheaper than U.S. steel, primarily because labor is so much cheaper. I think labor is a big piece of all of this, right? Totally, yeah. And I mean, make no mistake, labor, when you outsource, so take Tesla, for example. Tesla built a gigafactory in China to build their cars. And they found very quickly, and I think the reason why they did that is that car that they sell in China to a Chinese consumer out of a Chinese gigafactory is far more profitable than the one being built here in the U.S. because of wages. The wages in China are far less, and so that's certainly one of the benefits of outsourcing, and where kind of everybody comes up. Let's say the U.S., for example, that's the importer; they benefit from cheaper products. The other country that is the exporter, they benefit from those jobs to manufacture those things. And I think a broader sense, there's specialization that allows to happen, right? So we're selling NVIDIA chips around the world, and if we're trying to make NVIDIA chips, Nike shoes, Adidas shoes, you name it, right? Rubber tires here in the United States, that's a lot of resources being stretched for a lot of different industries. And we can't, any country couldn't specialize under that model, right? If you try to self-produce, you got to get relatively okay at a lot of different things. And that doesn't allow you to be exceptional in any one area. That's the trade-off. Yeah, certainly. Yeah, I mean, I think, I saw this post the other day, and of course it had that tariff chart, the reciprocal tariff chart, that we'll talk about here in a minute. Yeah. And it was really like, here's what's in effect. We're going to know, he's either going to be really wrong or really right. We're going to know in a year, right? I mean, you can't make the call so soon. I think there's a lot that can be, changed based on what's being, what was, I guess I shouldn't say proposed. I mean, what went into play here. Which are these reciprocal tariffs. So maybe let's talk for a minute on that, and what was proposed, how was the calculation done, and then ultimately what do we think it lands? Yeah, let me lead into what the expectation for the proposal was, right? Because they said reciprocal, and everyone in finance world, reciprocal in terms of the economics means, hey, Chris charges me, Chris is country A, I'm country B. And we trade with each other, right? But Chris slaps a 10% tariff on my goods that I export into Chris's country. So Chris is an importer of my goods, and he slaps a 10% tariff.
And for me, country B, if I were to say reciprocal, I would say, well, you're tariffing 10% on the goods I export to you. Therefore, I'm going to put a tariff on goods that I import from your country, Chris. That's reciprocal. Right? So the expectation of that was, well, everyone can see what China's tariffing on U.S. goods, what European Union is tariffing on U.S. goods, and everyone sets a expectation for Liberation Day, right? So the average of all those tariffs combined and all the goods that we bring in or export out of this country, that's about 7% tariff all in, right? So the Liberation Day comes in, we get a 10% universal tariff plus a very specific list of countries that have apparently trade imbalances, and we slap a tariff on top of the 10% to close any trade imbalance. So the 7% all-in expectation becomes 25% across the board. That's the negative surprise, right? So Liberation Day, I think Trump really honestly did think that the market was going to jump on that. And then the response, because he did it Thursday night.
Yeah, right? After market close.
After market close. Yeah. And Friday, or the futures.
No, Wednesday night, right?
Wednesday night, yeah. We had Thursday, Friday, that 2 days sell-off. So Wednesday night, futures market sold off 5%, which basically was the story on Thursday. And then on Thursday, China, I think, took a day to respond. And they responded in kind and said, well, we're going to raise tariffs on U.S. goods and bring down protections of copyright. So anything that can be copied that is U.S. product, China's now allowing that to happen. I know they had one of the biggest, fake markets, black markets for U.S. goods. If you want a fake Nike, you could probably find it in China.
Yeah.
And that's been knocked down. So any producer can make a Nike shoe now.
Interesting.
Yeah. So that's what caused another 5% sell-off on Friday. And then yesterday, Monday, we had a 5% down open, and then suddenly it closed flat. So I count that as a 5% positive swing. So what I'm trying to set up is expectations is one thing. You say reciprocal, we expect reciprocal. Right? You say reciprocal and you give us something that's much higher. That's where the negative surprise is. So the market was emotional in selling off. I probably haven't seen such a sell-off since COVID, which I think the numbers back that up. But the expectations weren't met. If Trump said 10% universal tariffs and let's be done with it, there might be a slight sell-off because the expectations were a little bit higher, but it probably would have been more orderly than what we've seen.
I mean, basically, in sum, what was announced was so much more dramatic than what was priced into markets.
Correct.
That's it, right? And if we look at we have this data, history of tariffs, and what's being proposed as of April 7th, in an estimate, it's a 25% average tariff rate for goods that are imported into the U.S. We were hovering around 2.5, essentially the day before, right? On average, if you look at all countries. And that brings us all the way back to, 100 years ago, more than 100 years ago. And so that was not anticipated for it to be that large. Now, what is potentially happening is kind of this anchoring approach of saying, here's a number, it's big, and then hopefully land somewhere in the middle. We don't know, but that, could be what's happening. It sounds like, as you can imagine, we've been on a bunch of different market update calls with a host of different asset management firms to just gather information. Many of these are global, so they have offices all over the whole world. And it sounds like a lot of countries are actually coming to the table, and there are a lot of negotiation talks happening. That's good news, right? Good news in that there could be something more final. And let me put an asterisk on my good news. What I mean by that is markets hate uncertainty. So kind of rolling the tape back a little bit here, this big sell-off was very much caused by the much more dramatic effect of what was announced and the uncertainty that it caused. Once that becomes more certain, really wherever it lands, I think stocks kind of find a bottom and find a way to sort of climb forward.
Yeah.
We just need a certainty in the environment. We don't have that right now because it's too fluid, right? He could come out to, this afternoon and say, we're doing a pause. That was yesterday potentially the cause of a big upswing in markets, 90-day pause. And they came out quickly and said, no, we're not interested.
They said it was fake news.
Fake news.
And
exactly.
I think what the argument I'm hearing from that side is, well, Trump said he was going to do exactly what he did. That's actually not technically right? Because he went through and basically with a sledgehammer approach and somehow brought in a wrecking ball. Like, you don't do that with market expectations, right? Because it goes with earnings too, right? If you just pull out NVIDIA and say, hey, we're going to earn $100 billion over the next quarter, and they come up at $90 billion, guess what NVIDIA is doing? They're selling off because they didn't meet expectations. That's what we're arguing.
Yeah.
And when you say reciprocal, we assume, and I guess wrongly, that you know what reciprocal means. I hate to be so blunt about it. It's just that's what it means, right?
Yeah.
And you should have just at least met that, at least for market expectations.
Yeah. So to land on just kind of where we think this is going to land, and this seems like it's sort of similar as again, we've been listening to a lot of market calls. So we tend to think that this lands around a 10% tariff rate. Again, right now it's 25. And so it's a lot higher. So we think that it lands somewhere around 10 when all is said and done. And we do think that ultimately becomes a hit to GDP growth and actually does raise inflation. So there's going to be some things to navigate once we're kind of through whatever is final here, because GDP will likely come down a little bit and inflation comes up. You've seen interest rates actually move around a ton in the last few days. How can you comment on that for a minute? Like, interest rates have been a whipsaw in the last 3 days.
Yeah. So as I mentioned with Cantor Fitzgerald and Howard Lutnick, for full disclosure, we do have interest in treasuries as well. So that's treasuries for the U.S. from zero days all the way out to 30 years are basically market traded, right? So the more supply, demand, or I guess demand and selling, buying and selling, that moves rates. The rates we typically focus on are the 10-year rates, the 10-year treasury. That has an influence on 30-year mortgage rates, simply because why not line up 30-year mortgage with 30-year treasury? You're paying your mortgage down over time. So the average duration of a mortgage is roughly 10 years. That's why banks will pin a 1% spread or bonus on top of the 10-year treasury. There's your 30-year fixed mortgage rate. So we did see quite a bit of demand come into treasuries, which pushed rates down, because when there's risk in the stock market, people sell their stocks and then look for a safe haven, which is U.S. treasuries. And the U.S. treasury that gets the most amount of attention is typically that 10 to 20-year range, where depending on how you're trading, you're selling your S&P, you're buying, equal amounts in 10-year U.S. Treasury. So that brings rates down. So right now the Treasury is at 4.1%, down from 4.7, which should bring, based on what I said, right, should bring 30-year fixed mortgage rates down. But mortgage rates are still persistently at 6.5%. And that tells me that the banks are unwilling to take any risk by bringing those rates down. But when we talk about rates, there's the Fed rates, which is overnight, and there's a bevy of other rates that you could look at. But broadly, rates across the board did come down. Credit, like high yield, junk rated credit, sold off more sharply because those are more linked to the ups and downs of the economy, right? The economy sputters, you suddenly have less creditworthy payers unable to pay their debts.
So we think, but okay, so rates initially fell and then rates went back up.
Yeah.
Can you comment on that? Because that's good.
So if you kind of go back to the basics, more buyers than sellers, more sellers than buyers, right?
Okay.
So when there's more buyers than sellers in regards to the U.S. Treasury, the rate goes down, right? There's more demand for U.S. Treasuries, so the U.S. Treasury interest rate ticks down. That makes sense when we had that the sharper part of the sell-off. Mm-hmm. And then yesterday, the 20-year Treasury sank 5% because rates went up. So someone was selling large amounts of U.S. Treasury or unwinding their safer positions to either buy back into the market or go to cash. So someone did cash out big globs of U.S. Treasury.
Yeah. Okay. That makes sense. Well, all right. So, I mean, I think just continue to move us forward here. So I think a lot of this is really just boiling down to the U.S. used to be, as of a handful of days ago, it was kind of the stability in markets and in kind of global policy. And the U.S. has definitely pivoted to, causing a lot of the volatility. So we'll see if that changes. Again, from our stance, hopefully we just get some certainty, out of the White House with like, here's how we're moving forward, and here's the environment.
Yeah.
That I think would help. And then, companies can try to figure a way to move forward.
At this point, countries, right? So they have to.
Good point. Yeah.
A country like Vietnam is claimed to have a 90% tariff against the U.S., which is not the case, right? Their tariff is 9.5%. So how do they close that gap, right? What the Trump administration is implying is, well, Vietnam needs to buy more U.S. goods. Mm-hmm. That's tough for an economy their size, right? They just can't spend that much. That's why they have a trade surplus relative to us, meaning they send more stuff that they make versus buy stuff that we export to them.
Right.
Right. They're basically the size of South Dakota in terms of economy. Right. So you could see where the imbalanced math doesn't seem as easy to negotiate down as what a reciprocal would be. Right. Let's go back to our country analogy, where you're country A, I'm country B. Mm-hmm. We say, you know what, this 10% tariff doesn't really make sense. Let's go to zero and really prosper between the two of us, right? Mm-hmm. That's should be the real end goal. And I think that's what we're seeing in terms of internal strife with the administration, where, Elon Musk obviously has a lot of global interests and a lot of interest in making countries play nice with each other.
Yeah.
Because I think, frankly speaking, onshoring all this industry and manufacturing doesn't really make sense for the U.S. One, it takes years to build a factory here.
Yeah.
Like years. I'm talking nearly 10 years. And two, do we have the demographics to even fill these factories with workers? I don't think so.
Yes. And it's the difference of $3 an hour wages versus $38 an hour wages too. Like that's...
what Chris is referring to is the Bureau of Labor statistics. He didn't make those numbers up. To make a car in the U.S., the average wage of an auto worker is $38 an hour. The average wage of a Mexican auto worker is $3 an hour. Mm-hmm. And then that 10x difference is either going to be flowing through the price, or we got to, you know what I mean? Like we got to somehow figure out bringing down labor costs in the U.S.
Exactly.
Which has happened, right? Automation.
And that's a whole, but how do you do all that in a period of months or a year? I mean, that's
impossible.
I think,
yeah,
frankly impossible. I mean, and there are, look, China has a lot of examples of how they can build, rail, bridges, build things so fast relative to the U.S. I mean, it would be impossible is a good word. It's impossible to stand up a factory in 6 months and start producing cars or chips or whatever. Despite the partnerships that have been in the news a bit with Intel opening a campus in Phoenix. I think there was a TSMC partnership. Like there's these things that are getting announced, right? But it's not like it just flips a switch and turns on.
Correct. They've been in the works for years, and the one in Phoenix, took 12 years to build.
There you go. Yeah.
So
and it just turned on. Like, oh, great, good time.
Yeah. But, so I don't think the end goal, if we're being just completely realistic about it, is to onshore all this, because it just wouldn't. Personally, I wouldn't want my kids to work in a Nike factory. To be blunt, it's, you know what I mean. Like that's a tough life, and I probably wouldn't think that would be the real end goal of all this.
Let's talk about markets for a bit. So I wanted to leave everybody with some data. We try to look at this stuff as objectively as we can. And what does a recovery look like when a drawdown like this happens? And I say that because, you might be thinking, well, this time is different. And you would be correct. This time is different. They're all different. But market drawdowns, I think it's a Mark Twain quote, history doesn't repeat itself, but it rhymes. So we have all this data, right, on what markets have done in history when they draw down and then the time to recover. So I wanted to share a couple of things that I think would be interesting. So the first is average S&P 500 returns following a 10% correction, which we are in, right? The S&P has fallen more than 10% from its prior high, so we are officially in correction. So this is data since 1980. There have been 21 corrections since 1980. That's actually wild. 45 years, 21 corrections, one every other year. Okay, interesting.
Pretty rare occurrence, though.
Interesting, yeah. I thought it was more than that. Okay, so this is also broken out by, did we have a recession within 12 months or did we not have a recession within 12 months? And I think what's important here is if I look at the 6 months out from the date at which the S&P hits a minus 10, if we had a recession, it's still a plus 4% return. If we didn't have a recession, it's a plus 9% return.
Yep.
1 year from the day that the market drops 10%, if we had a recession, market's positive 1 on average, and if we did not, it's positive 14.
There we go.
It's likely to go the other direction in time. And so that's really what we want to leave with folks, is that we don't know where the bottom is or was or what's going to be announced in the next 5 minutes or tomorrow. But we know that on average, time in the markets is the key to successful long-term investing.
Yeah, very well put. And I think even in the worst case scenarios, you could just look throughout history, right? 1987, the savings and loan crisis that the market sold off and recovered before the year end, right? That was a 30-some-odd% recovery in a matter of less than 2 months. So these things, that was in the 80s. I can imagine trading working a lot faster than the 80s now.
Yeah.
And I'm not promising any kind of V-shaped recovery here. I'm just saying that the impediments that are going to get removed here, right? Chris established a ceiling of 25% tariffs. Let's just play that out. The market would sell off if we suddenly get higher tariffs than that. Mm-hmm. Can you imagine a world of 30% tariffs? The market wouldn't like it, obviously, right?
Yep.
But what about 21%? What about 19%? Still sucks, but still better than 25%. Mm-hmm. And you would be surprised how positive market reactions will follow bad news. All the news has to do is not be as bad as expected, right? The mechanics behind that, quite a bit, right? Everyone who went to cash or even treasuries would go back risk on. That's one thing. There's buyers there, right? Short selling is another important piece of the market where it flips, right? You're selling first, then you're buying to cover. Mm-hmm. But when you're buying to close out a position, you're a buyer all of a sudden. Mm-hmm. Then you suddenly have cash buyers and you have short covering going on, right? And you have paychecks coming in every 2 weeks that just naturally flow into the market. I think there is what Chris said about performance after a 10% correction. Even in the face of recession, there is still money flowing in to the markets. So you strip away all the headlines there, and just, you could replace it with any nasty headline. Ukraine, right? Ukraine, Russia, inflation. We've always kind of come out the other side of it. And yes, this is scary. And Chris and I aren't impervious to, scary down markets either. It weighs on us, but we try to keep a level head about it. And I think that's what the key is figuring out what the other side could be and what that pathway is. As weird as this all sounds, there could be a positive market outcome if tariffs were to be enacted and pushed through. We're the day before the second leg of tariffs are expected to go in effect on April 9th, just tomorrow. And if they're not as bad, or they get delayed, or we somehow negotiated within 2 days trade policy between multiple countries, like, you see how all these things, I'm not going out on a limb by saying that. That's all within the realm of possibility.
Yeah.
Right? And though we don't know, you got to play the probability of all this, right? And the markets have a, 2/3 upside bias throughout history. And then we've gone through wars, like Vietnam War, the Iraq-Iran War, like the Gulf War. You name it. Bad news at feels like every year there's a bad news point that gives you good reason to sell. Yes, this was good reason to sell before all this happened, but one, it's tough to time the markets on not just the front end where you avoid the down, like the crash. It's the trick is getting back in. And
it's two transactions. Yeah.
The market is emotionless when it comes to that. It does not need a green light. All it needs is a little bit of hope, a glimmer of hope, and then the buyers are back in. We saw it this morning. The market opened 5% and did give it back, but still, you gotta
now.
Yeah, you gotta. Yeah, thanks for the luck podcast. But you see what I'm saying is there seems to be buyers looking for reasons to get back in, and if you're looking for a green light, it's too late. Right? If it's already in the Wall Street Journal, that's always the day before. You can't really base forward-looking activities like investing on history. Like everything you see on CNBC or Fox Business, that's information that someone's already traded on, right? Yeah. Like there's no red carpet rolled out for someone who is out of the market or is looking to deploy cash into a market, if that makes sense.
Yep.
We've always approached this by saying the market's at a discount relative to a date in the past. Mm-hmm. Wouldn't you love to get a 20% discount on shoes or furniture or appliances, right? There's your chance. The big caveat is there's a scary component to it. I get it. But if you plug your nose and buy, your future self will, just looking at the odds, right? You'll think yourself.
Some of these companies are back to 2020 levels. I was looking at a chart of Amazon. Amazon's at about $175 a share. It sat at $176 a share September of 2020. I mean, you can buy more Amazon today in 2025 with money that you didn't have in 2020 at 2020 prices. I mean, some of these drawdowns are really quite significant. I think Alphabet was pretty similar too. Yeah. So Google topped at 149 November of 2021. It's sitting at 149. Some are still up from those levels. Microsoft's like another 10% away or so. So like there still is more room to go to get to those levels. Yeah. But my point is like some of these companies have come down a lot. I mean, that's why the NASDAQ is down a lot more than the S&P, because it weighs into these tech companies more. Again, this is not us looking at this going like, this is all positive. We're just trying to look at the data and look at the history and say when stocks do what they're doing right now, generally there is upside on the other side of this. I'll leave you with one more, and then we'll wrap up. Following the worst days. So the market has bad days. What's the return 1 year later? I'll just give you the averages. So the average worst days in the market, this goes back to since 1957, so it's a long average, down 8.9%. It ranges from like 6 to 20, believe it or not, like in the flash crash of 87. The return 1 year later, on average, 30.9%. The worst month, on average, bad months are 11.5% down. The return 1 year later, 23.4%. And the worst 3 months, on average, 20.8% down. Return 1 year later, 28.5%. So again, I'll end kind of where we started. I know what you're thinking. This time is different, and it is different. If you look over the history of a lot of this data, some of which of this crossed with when we had different tariff policies in the U.S., right? Markets ultimately found a way to go the right direction. So our message is, stay in, stay calm. The money is made in markets like this. Okay, one more actually. The best days follow the worst days within 2 to 8 days. The best market days follow the worst market days generally within 2 to 8 days. So it's, the moment at which you want to hop out is right when those best days happen.
Yeah.
And those best days are what power, believe it or not, a lot of your return. It's like 70% of your return over time. That's our message. That's our thought. We're here to kind of look at the data and deliver that. And we'll keep folks updated on what's going on with policy, but from a market standpoint, keep a level head as much as you can.
Yeah. I think the best times to buy feel the crummiest in the moment.
Totally.
Yeah. And we're not, like I said, impervious to that. Again, we're invested along with clients, and it doesn't, so we know exactly how it feels, right? Mm-hmm. Which is kind of not unique in this business. I would hope a lot of advisors are invested with the clients, but you got to know that we're in it with you, right? We didn't go to cash. We didn't do anything cute. I think that's the big thing to learn from all this is, because we always hear these regret stories. Oh, I should have invested more in 2020. I should have invested more in 2008. Yeah. I should have invested in 2011, right? That was like a little mini crash.
Yeah.
And I think you'll be saying this in, hopefully sooner, but by year end, I should have invested in April of 25, right?
Right. Yeah.
It's one of those moments where these pullbacks aren't common. They feel painful. That's probably why we remember them more.
And they're quick.
Yeah, and the market doesn't gift you things like this for free, right? The cost is the lower price, but also the fear that accompanies it, right? That's the risk. All
right, that's all the time we have for everyone today. Thanks so much for tuning in. We'll catch you again in a couple of weeks, and we'll have an update on where things are. Hopefully we've kind of caught the recording of this around the craziest of times, and when we release the next episode, there's a little bit more certainty.
Yeah.
That's it. Talk soon.
All right. Thanks, everyone.